Hey guys, it's Rick. You know how much I love real estate, right? It's been the cornerstone of my investment strategy for years, but I also know that not everyone's ready to dive headfirst into buying rental properties or flipping houses. It can seem daunting, especially when you think about the down payments, the mortgages, the late-night calls about leaky faucets. But here's the good news. You can still tap into the incredible potential of real estate without actually owning any property. In this video, I'm breaking down the top ways to invest in real estate without ever having to deal with tenants, toilets, or termites. Let's kick things off with real estate investment trusts, or REITs for short. Think of REITs like the low-maintenance friend of the real estate world. They own and manage income-producing real estate like apartment buildings, shopping centers, even cell towers. And the best part? They're legally required to pay out at least 90% of their taxable income to shareholders as dividends. Now here's why I love REITs. They're incredibly liquid, which means you can buy and sell them on major stock exchanges just like you would with any other stock. This is a huge advantage over traditional real estate, where it can take months or even years to sell a property. Plus, REITs offer instant diversification. Instead of putting all your eggs in one basket or one property in this case, you're investing in a company that owns a portfolio of properties across different sectors and locations. You can find REITs that focus on specific types of real estate, like healthcare REITs that invest in hospitals and medical office buildings, or industrial REITs that own warehouses and logistics centers. This targeted approach allows you to tailor your investments to specific sectors you believe in. But remember, like any investment, there are risks involved. REIT prices can fluctuate, and dividends are never guaranteed. Alright, let's talk about real estate crowdfunding. This is where things get really interesting, especially if you're just starting out and don't have a ton of cash to throw around. Crowdfunding platforms allow you to pool your money with other investors to buy into big-time real estate projects that you wouldn't be able to touch on your own. We're talking about luxury condos, multifamily homes, even those sleek office buildings you see in downtown LA. The minimum investments can be surprisingly low, sometimes as little as a few $100, which makes it a great way to get your foot in the door and start building a diverse real estate portfolio. Now here's the thing about crowdfunding. It's not just about being a mini mogul. It's also about supporting projects you believe in. Many platforms offer investments in sustainable development, affordable housing, and community-focused projects. But let's be real, with any investment that promises high returns, there's always an element of risk. Crowdfunding is no different. It's crucial to do your due diligence on the platform itself, the developers, and the specific projects you're considering. And remember, diversification is key. Spread your investments across different projects, property types, and geographic locations to minimize your risk. Now, if you're the type of person who prefers to sit back, relax, and let someone else handle the heavy lifting, then real estate mutual funds might be right up your alley. These funds pool money from multiple investors, just like crowdfunding. But instead of investing directly in properties, they invest in a diversified portfolio of REITs and real estate companies. Think of it like hiring a professional driver to navigate the complex world of real estate investing. You get in, tell them your destination, your financial goals, and let them handle the route. This is especially beneficial for beginners who are still learning the ropes, or for those who don't have the time or desire to actively manage their investments. One of the biggest advantages of real estate mutual funds is instant diversification. By investing in a fund, you're automatically spreading your risk across a wide range of properties, sectors, and geographic locations. And just like REITs, real estate mutual funds offer liquidity. You can buy and sell shares on major stock exchanges, making it easy to adjust your portfolio as needed. But keep in mind that while mutual funds offer professional management and diversification, they also come with fees. Chapter 4, P2, P-Lending, Be the Bank, Reap the Rewards. Let's be honest, who hasn't daydreamed about being the bank and collecting interest? Well, with peer-to-peer lending for real estate, you can actually make that dream a reality. Platforms like Lending Club and Prosper connect borrowers looking for real estate financing with investors like you who are willing to lend money and earn interest on those loans. It's like cutting out the middleman, the big banks, and getting directly involved in the financing of real estate projects. Now, you might be thinking, Graham, isn't that risky? What if the borrowers default on their loans? And you'd be right to ask that question. P2P lending does come with its fair share of risk, just like any other investment. But here's the thing. Platforms mitigate that risk by allowing you to diversify your investments across multiple loans. Instead of putting all your eggs in one basket or one borrower's ability to repay, you can spread your money across a pool of loans, reducing the impact of any single default. Plus, many platforms offer different risk levels for investors to choose from. You can go for lower risk loans with lower interest rates or higher risk, higher reward options. Just remember, before you start throwing money at every real estate project that comes your way, it's crucial to thoroughly vet the platforms, the borrowers, and the specific loan terms. Chapter 5. Property syndication, teaming up for massive returns. Alright, let's talk about property syndication. This is where things get really exciting, especially if you're looking to invest in larger commercial real estate projects like apartment complexes, office buildings, or even those massive shopping malls we all secretly love to hate. Property syndication is all about teamwork. It's like forming a real estate dream team where you, the investor, pool your money with other investors to purchase and manage a property under the guidance of an experienced sponsor or syndicator. Think of the syndicator as the coach of your real estate team. They're the ones who find the deals, handle the due diligence, secure financing, manage the property, and eventually sell it for a profit. Your role as an investor is to provide the capital and reap the rewards. Now, syndications can be structured in different ways, but typically investors receive passive income through distributions from the property's cash flow, and they also benefit from any appreciation in the property's value when it's sold. One of the biggest advantages of syndication is access to deals that would be out of reach for individual investors. We're talking about multi-million-dollar properties that can generate significant cash flow and long-term appreciation. Plus, syndication offers the benefit of professional management. You have an experienced team handling the day-to-day operations, so you don't have to be a landlord or property manager in your spare time. But just like any investment, there are risks involved. It's crucial to thoroughly vet the syndicator, their track record, and the specific property you're investing in. And as always, diversification is key. Spread your investments across different sponsors, property types, and geographic locations to mitigate your risk. Chapter 6. Real estate options, controlling the future of real estate. Alright, let's wrap things up with a strategy that's a little more advanced, but definitely worth understanding. Real estate options. Options contracts give you the right, but not the obligation, to buy or sell an asset, in this case, real estate, at a predetermined price within a specific time frame. Now I know what you're thinking. Graham, this sounds complicated. And you're right, it can be, but it can also be incredibly powerful if used correctly. Think of it like putting a down payment on the potential future value of a property. You're essentially betting on whether the property's value will go up or down without actually owning the property. There are two main types of real estate options: call options and put options. A call option gives you the right to buy a property at a specific price within a certain time frame. This is beneficial if you believe the property's value will go up. A put option, on the other hand, gives you the right to sell a property at a specific price within a certain time frame. This is useful if you believe the property's value will go down. Real estate options can be a great way to control a property's value appreciation without the large capital outlay required for a traditional real estate purchase. However, it's important to note that options trading is inherently risky. If your predictions about the property's value are wrong, you could lose your entire investment. Chapter 8. Unlocking real estate investing. So there you have it. We've covered a lot of ground, from the simplicity of REITs to the complexities of real estate options. The key takeaway here is that you don't need to be a millionaire or a landlord to invest in real estate. There are so many innovative and accessible options available today that can help you build wealth, generate passive income, and diversify your portfolio without ever having to deal with a single tenant or leaky faucet. Remember, just like any investment, it's crucial to do your research, understand the risks involved, and choose strategies that align with your financial goals and risk tolerance. The world of real estate investing is waiting for you. So get out there, explore your options, and start building your real estate empire. Investing in real estate without owning property has become more accessible thanks to innovative investment vehicles like REITs, crowdfunding, mutual funds, P2P lending, and syndication.